However, that being said, all the focus now on what Jay Powell will do the next time he speaks. I want to bring in Kathryn Rooney Vera. You know, Kathryn, the ECB speeding up their bond purchasing program, that put a lift to the markets yesterday. But everyone's concerned with Chairman Powell, particularly this thing called SLR. It's a supplemental program that people should understand that banks have to hold a certain amount of money to offset other assets. That was suspended. And so they were able to use that money for other things. At the end of this month, they either have to go back or that extension is going to go on. I think that's going to be the key to the bond market settling down and even the stock market settling down.
It absolutely is, Charles. There's no doubt about it whatsoever. Any disincentive to purchase treasuries when we have such a massive flux of new debt that needs to be issued to finance almost $1 trillion in COVID stimulus back in December, $2 trillion just announced, and an additional multi-trillion dollars in a budget plan coming up to be announced this month is, I think, crazy. So the most likely scenario here is the Fed does extend this reprieve. This reprieve is from a regulation, as you mentioned, came after the 2008 crisis. And basically what it does is it allows banks to buy treasuries, accumulate assets, accumulate deposits, accumulate treasuries without having to sideline a portion of their capital that doesn't earn anything. So they've been able to buy the issuance that really has to happen because, as you know, Charles, the Treasury market has been under severe pressure for the past couple of months with yields rising 60 basis points higher today, prices dropping. This needs to happen, and I think, Charles, that the Fed is more likely to extend this reprieve for this regulation rather than engage in Operation Twist or outright yield curve control or caps on interest rates.
It's like low-hanging fruit, in my opinion, and to your point, we've been watching these auctions, which we normally don't watch, in part because there haven't been buyers, right? Foreign buyers have kind of walked away. And if we don't have banks buying them, if banks are selling them, forget about it. We're in trouble.
Imagine.
Hey, I want to also talk another outcome of this shift, this 40-year bond market rally that looks like it's fading away. For decades, financial advisors always recommended what they call the 60-40 portfolio. Stocks to bonds. There are many signs that this is no longer going to work. So what are you telling conservative investors? How should they be balanced, or what should the new approach be?
Well, the Fed has now $8 trillion on its balance sheet. The Fed is owner of a third of all U.S. Treasuries and has historically been the biggest absorber of new issuance. So that has to continue. And if it doesn't continue, then we're going to see more upward pressure on yields. So this structural downward trend is threatened by the potential of less demand for this new issuance. So it's unlikely, Charles, that we get a retracement. Right. No, I think the alternative has to be look at alternatives. Alternative assets have a very low, if not zero, correlation with the markets. We're talking private equity, venture capital, even the commodity space. I think we're going to enter into a commodity super cycle because of the weak U.S. dollar, stronger economic growth. So I think we need to have a bigger proportion, which has historically been very low, of investors' asset allocation allocated to what is alternatives. No one can time this. We don't know when the ticking time bomb is going to happen when we get inflation. The Fed has to hike rates, but that's coming. So I think we need to be prepared with low correlation assets.
Kathryn, we love that professional advice because a lot of people really are grappling with this. Thank you very much. Have a great weekend, my friend. And folks, we'll be right back.